Hello. Welcome to another episode of Money Shiksha with Brijesh Parekh. I'm your host and wealth coach Brijesh Parekh. In today's episode, we are going to discuss how can investors leverage the advantages of dynamic asset allocation in different market scenarios. Dynamic asset allocation is an investment strategy that involves adjusting the allocation of assets in a portfolio based on changing market conditions. By leveraging the advantages of dynamic asset allocation, investors can potentially benefit from different market scenarios. Here are a few ways investors can do this. 1. Tactical allocation. Dynamic asset allocation allows investors to make tactical shifts in their portfolio allocations based on their assessment of market conditions. For example, if an investor believes that a particular asset class is undervalued or poised for growth, they may increase their allocation to that asset class. Conversely, if they believe an asset class is overvalued or likely to underperform, they may decrease their allocation. This approach allows investors to take advantage of short-term market opportunities. 2. Risk management. Dynamic asset allocation can be employed as a risk management tool. By continuously monitoring and adjusting the portfolio allocation, investors can respond to changing market risks. For instance, during periods of high market volatility or economic uncertainty, an investor may reduce exposure to riskier assets and increase allocations to more defensive assets, such as bonds or cash. This approach helps manage downside risk and potentially preserve capital during turbulent market conditions. 3. Long-term growth potential. Dynamic asset allocation can also help investors capture long-term growth potential by aligning the portfolio with changing market trends. By actively adjusting the allocation to different asset classes, investors can potentially participate in sectors or regions that are expected to outperform in the future. This approach allows investors to adapt their portfolios to evolving market dynamics and potentially benefit from long-term growth opportunities. 4. Diversification. Dynamic asset allocation provides an opportunity for diversification across asset classes. By investing in a mix of different asset classes, such as stocks, bonds, real estate, and commodities, investors can spread their risk and potentially enhance returns. A dynamic approach allows investors to rebalance the portfolio periodically based on market conditions and maintain an optimal diversification level. 5. Regular monitoring and analysis. To effectively implement dynamic asset allocation, investors need to regularly monitor market conditions, economic indicators, and asset class performance. This requires conducting thorough research, staying informed about market trends, and analyzing data. By staying proactive and well-informed, investors can make informed decisions and adjust their portfolio allocations accordingly. It's important to note that dynamic asset allocation requires active management and involves some level of risk. Successful implementation relies on the investor's ability to accurately assess market conditions and make effective allocation decisions. It can be beneficial to consult with a financial advisor or investment professional who specializes in dynamic asset allocation to help develop and execute a strategy that aligns with your investment goals and risk tolerance. That's all for today's episode of Money Shiksha with Brijesh Parekh. I hope you found these insights helpful and inspiring. Join us next time for more valuable tips and strategies to unlock your financial potential. As always, thank you for tuning in. Be sure to subscribe to Money Shiksha with Brijesh Parekh and never miss an episode where we bring you more insights, strategies, and inspiration to help you achieve financial success.